Emerging market bonds are for investors who are prepared to accept the risk of paying more for lower credit standards and slightly higher volatility. Analysts call such bonds safer than developed markets because governments offer more protection in the event of default, but in a crisis, governments may tend to feel entitled to collective payback. A well-diversified portfolio of emerging market bonds is at least as safe as that of their developed counterparts. There are growing parallels between the largest economies in the world that are sending investors fleeing from stocks. China has been at the center of concern and confusion among American investors, but there's a whole new world of issues and doubts to deal with when it comes to Europe and Japan. Britain made a spectacular entry into this financial purgatory in late September by unveiling plans for huge, unfunded tax cuts, sending the value of sterling crashing. It is far from the only wealthy country where government bonds have become unusually exciting. Worse, the dullness may not return for some time. Part of the thrill has little to do with government's policies. This year, central banks across the rich world have repeatedly raised interest rates, shrinking the present value of the coupons bonds pay out and causing their prices to sink. No one knows how high rates will rise, and for how long they will stay there. So bond markets are jittery across the board. The MOVE Index, which measures how clueless bond investors feel about the future, is at nearly twice its average over the 5 years to February 2020, when the pandemic first shocked markets. Monetary policy surprises are not new to developed market bond investors with long enough memories. Just think of the Technicolor 1980s. Instead, today's suspense is over two novel forms of uncertainty: whether rich world governments can afford the vast volume of debt they are issuing, and whether the market can absorb it. Start with the quantum of debt. Most rich world governments already have heaps of it because they spent the past 15 years bailing out their citizens and companies from successive crises. When financial panics gripped banks, lockdowns forced shops to close, and huge energy bills threatened to freeze households, the reflex was to dole out public money. Fiscal largesse remains in fashion. America is throwing bungs to green industries, and there is no end scheduled to Europe's lavish energy subsidies. This habit of big government was formed during years in which rock-bottom interest rates kept funding costs low and rich world creditors lenient. Now the interest bill is rising, exposing the spending plans of developed market governments to the kind of scrutiny formerly reserved for their counterparts in the emerging world. Moody's Analytics, a research firm, projects that by the middle of this decade America's Treasury Department will be spending more on interest payments than it does on defense. Britain's Office for Budget Responsibility, a watchdog, estimates that this fiscal year its government will disburse £120 billion or $146 billion on interest, the equivalent of 80% of the budget for England's National Health Service. For a decade or so, investors were not alone in buying the debt that funded rich world governments. Throughout the 2010s, and until recent months, much of it was being acquired by central banks through quantitative easing programs. Now those buyers are disappearing, leaving bond investors alone to soak up the excess. Hence the second big unknown: are bond markets deep enough to cope with the coming flood? In the fiscal year of 2023, America's Treasury may need to borrow up to $2 trillion from the market, nearly twice what it borrowed from investors annually during the 2 years preceding the pandemic and 4 times the average in the 5 years before that. Citigroup, a bank, reckons Britain's government will need to seek twice as much net cash from the bond market in the next fiscal year as it has in the past 8 combined. If it had been proposed by a Latin American government, such an issuance schedule would have already sent bond yields soaring. Rich countries have long enjoyed much more freedom and evaded the full price of fiscal incontinence. Now, though, they are looking to investors to buy vast quantities of debt amid rising borrowing costs and a murky economic outlook. The bond market drama could have many more installments. Please subscribe for the next video. Thanks for watching.